Welcome to the AWA Market Minute, breaking down current economic, financial, and political events that impact today's retirees. Our investment committee performs hours of research and analysis every month so that we can share simple summaries with our clients in 30 minutes or less. Featuring investment advisors Jaron Monk, Mason Page, Chief Investment Officer Scott Hoxer, and your host, founder and CEO Paul Coles.
Well, welcome everybody to this month's edition of our AWA Market Minute. We apologize for a little bit of the late start. As you can see, we're in our new office, in our new studio. I'm Paul Coles, and as always with me is our Chief Investment Officer, Scott Hoxer. We're excited to have another 30 minutes to be with you guys today, and hopefully we have an opportunity to deliver some good information. As always, the information that we like to deliver is designed for a broad audience. It's designed to be educational in nature and not intended to be specific advice for anyone's situation. One-on-one, if you want to seek that advice, reach out to your team here at Alliance Wealth Advisors. Schedule a time to meet with one of the advisors here, and we'll make sure we talk to you about your unique circumstances. So, at the risk of exposing my ignorance, Scott, I wanted to open up today's discussion with a story from my just home from my mission, first year of college days. So I was at a function, right? I was going to my college was in finance, classes were in finance, and I was at a function where a buddy of mine was explaining to me about this family member who was starting this new company, and the family member actually came over and introduced himself. And essentially what this was a new technology that he claimed to have invented on kind of clean burning fuel for how to kind of refine oil in the Uinta Basin. And gosh, for a 21-year-old kid who had very little understanding of investing and early stage investing and valuations of companies, it sure sounded like a pretty good deal. Have you ever done any early stage investing?
Not a lot, but yeah, very, very familiar with it.
All right. Well, so I wasn't at the time. And so for me, I thought, gosh, if I can get a couple $100 together and invest in this early stage investment. So like I said, this is my first soiree in investing. So I opened up an account at Fidelity. This was a thinly traded stock, but it was publicly traded. And so I was able to identify it. I'll never forget the ticker. It was ROIL, Royal. And I went ahead and I took, $500 and I invested it into this idea, this concept, this stock. And sure enough, I watched over the next 6 months as that $500 turned to 400, 300, 200, 100, and then disappeared. And I watched that, for quite a while, and looked for all the updates, and never an update would come, and realized, it's kind of soured my taste on investing. It took me several semesters of additional information and learning about finance and accounting before I really, got a better comprehension as to what I was involved in, and how investing actually worked. And I considered that $500 another tuition payment.
Yeah. Yeah. You learned the lesson of the, distinction between speculating and investing.
Right? Yeah. That's exactly right. Yeah. Speculating and investing, and the due diligence that goes into an investment, was something that I was not trained in at that stage of my life. But it's interesting, like the psychology that goes into, early stage investing. And I think everyone gets really excited about the idea of like the hot stock tip, and your friend at the water cooler tells you about this hot stock tip. And I think everyone wants to invest in Amazon and Jeff Bezos while he's still in the garage, right?
Yeah, and I think it speaks to human psychology. There's so much euphoria that we feel of having the potential to make a lot of money. And there's actually been studies done where the potential of gaining money and the psychological, things that occur with that are greater than when you actually make the money, which is crazy, right?
Right. Yeah, and I've even seen people who will like overstate their earnings of an early stage investment so that they can kind of brag about that. They don't care about the reality. They would rather have the idea that they've done really well in some early stage investment. Everybody wants to have, bought Tesla before Tesla was what it is today. But there is something to that, the emotions that go into it. And it couldn't be any more dissimilar from a fundamental approach to building an investment portfolio.
Yeah.
Right. And I think the biggest gap between those things is just education on how investing actually works and how to perform due diligence on businesses. So I thought maybe just before we introduce our guest today, Scott, let's talk a little bit about, I think for the benefit of all of our clients, I always like to be the dumbest guy in the room. Let's talk about capitalization of businesses, right? Small cap, mid cap, large cap. What does that mean?
Yeah, so when we talk about market capitalization, that's the value of the equity of the company that we're talking about. And so there's this notion of large cap, which is anything north of $10 billion. You also have mid cap, which is like $2 to $10 billion. You have small cap, which is between $250 million to $2 billion. And then there's also a category called micro cap, which is less than $250,000 or $250 million. And the smaller in market cap you go, kind of the greater potential upside, but also significantly
greater risk, right? The bigger the potential reward means by nature we're going to incur a potential risk there, and I think that makes sense, right? If a company is growing and there's still a smaller amount of money they're working with, and in theory that business is not as tested, not as proven, and so you're taking on a little bit more bigger risk. Where if you're dealing with an Amazon, that's a mega cap company, the business model has been tested and proven in the trenches, and we know what it is. We know exactly what we're dealing with there. So the other part that I thought maybe would, just for the benefit of everybody on the call, style boxes, right? So when we talk about style boxes, those are those little tic-tac-toe boxes you'll see on Morningstar, and you'll see the difference. On the one part, you'll see kind of small, mid, large cap. But then on the other part that kind of goes horizontal, we'll see kind of the difference between growth and value, and then sometimes core in the middle there. What does that mean?
Yeah, so when you talk about growth are companies that are still in the active growth phase. They're pouring a lot of their earnings back into growth, and a lot of their earnings are going to be in the future. Value is more established companies where there's not a lot of growth occurring, but they're, solid operations, and a lot of their earnings are paid out via dividends. And then kind of that middle, or that blend or core, is going to be a kind of a combination of the two.
Perfect.
Yeah.
So understanding style boxes and capitalization, now we can start getting a little bit of a framework around understanding what kind of investments I'm even doing my analysis and due diligence on. So if I'm in that square that says I'm in small cap or mid cap, I know I'm dealing with slightly smaller size companies. And if I'm in that square that says growth, I know I'm dealing with companies that are reinvesting their earnings back into the development of the business, not paying their shareholders back a dividend. And so that style box matters to me as I kind of talk through today's subject matter, and better understanding what we actually need to perform as far as due diligence goes when we're going to invest in any business that is still in that kind of earlier stage development.
Yeah.
So with that, Scott, maybe let's introduce our guest today.
Yeah. So we're going to be joined today by Congress Asset Management. They're a third-party money manager that we work with.
One of our favorite.
Yeah, absolutely. No, top-notch firm. And we're going to be joined by kind of three of their investment teams. So Brian Cunningham's going to join us. Brian is a vice president and a regional director. Also going to be joined by Aaron Fellows, who is a chartered financial analyst, also a member of the mid-cap growth team. Also be joined by Nick Coop, who's also a chartered financial analyst, and he is a member of the SMID growth investment team. So SMID means small and mid-size. So as we talk about market capitalization, we're going to be talking about small cap and then mid-cap as well.
I mean, a little acronym, right? SMID, small, mid.
Yeah.
SMID. They just combine those words. So Brian, go ahead and turn on your camera so we can introduce you to all of our clients here today.
So it looks like, first off, thank you both for very much for having us on the call. Looks like we can't get through on the camera, but myself, Nick, Aaron, we're sitting here in our conference room, and we're very happy to be on the call. So thank you again for having us today, and we'll hopefully just be able to do this. If you can hear us clearly, we can do this from here.
We're loud and clear, and for everyone listening on the podcast, they won't know the difference. So
okay.
Although we're probably missing a backdrop of a nice spring day in Massachusetts, right?
Pretty much, yeah. Nice and gray outside in March. So not missing too much.
Well,
Okay.
listen, here in Utah, we've had an eternal winter. I'm supposed to coach my daughter's soccer practice next Wednesday, and we're buried under 2 feet of snow. So we'll see how that goes.
Yeah, that you guys have gotten a lot of snow this year. It's pretty crazy.
Yeah.
So maybe walk us through, and Brian, Nick, or Aaron, any of you can take this, but talk us through how Congress picks the stocks in their portfolio. I know the methodology for both the SMID and MID strategies is very similar, but walk us through how you guys go about, from the universe of thousands and thousands of stocks, how do you identify those constituent components of your portfolios?
We're a boutique asset manager, and Scott, you had mentioned this when it comes to fundamentals. What we do is we're quality growth biased. So we're looking for really 4 key investment tenets for the names that we choose, and that's growth, profitability, franchise, and valuation. So really what that means is we're looking for companies who are growing, but they're also profitable at the same time. So this is that quality growth approach. We're really looking for things like, when we go to choose a new name, positive free cash flow, low debt levels, companies who are expanding margins. And it's provided a very attractive risk return profile across each of the strategies. With that being said, I'll have Aaron just dive a little bit further into when we take a look at the universe, kind of how we filter out those specific securities.
Hey everybody, this is Aaron Fellows. Thanks for having us on today. So just as we kind of look at our universe, as you guys kind of mentioned early on, we're looking at kind of the smaller and mid companies in the SMID and mid strategies. So in terms of market cap, we're looking at in SMID anywhere from 300 million to 20 billion and 800 million to 20 billion for mid cap. So we cast a pretty wide net. And then as Brian mentioned, then we start getting into kind of the fundamental analysis, the bottom up, looking at the balance sheet, the income statement, the cash flow statement, making sure that it has the characteristics that we're looking for, have the secular growth themes that we think are going to be kind of sustainable for the long term. And so that's kind of how we look at as we start looking at making an investment in a company.
Yeah, and I like, I want to kind of touch on a few things that you guys, have mentioned there. And one is that you guys look for companies with strong balance sheets and earnings and strong financials. And what that means to our clients is we want proven business concepts, so from Congress's perspective, they're not buying ideas or taking a flyer on ideas like happened during the .com bubble at the turn of the century. They are looking for things that are, yes, they're maybe in the earlier stages, but they have very, very strong earnings and strong fundamentals. And where that's important is when we do have economic slowdowns, the wheat is separated from the chaff, and those smaller or mid-sized companies that don't have strong financials, they fall by the wayside. Am I stating that accurately, you guys?
Yeah, absolutely. Yeah.
Perfect. So walk us through, maybe walk us through kind of the life cycle of an investment that you guys have chosen. You can choose any kind of name, but, one that came to mind for me was Monolithic Power. You guys made an investment in Monolithic Power in 2020. That's had a tremendous run. Walk us through maybe how you guys identified that, stock, what's kind of kept you continuing with that. And then when it comes time to part ways with that stock, what will be some of the triggers for you guys to kind of move on to the next in line?
So I'll take a stab at this to start. This is Nick again, by the way. So I was on the mid-cap growth committee actually when we added this, and the secular themes in the semi space are obviously very strong. Semis are being used in more and more things. So that's kind of an underlying theme there. And with Monolithic specifically, it was a company that was smaller in their markets. They were outgrowing their end markets by 10 to 15% across a cycle. Customers in the space, they mostly do power management solutions across industrial, auto, consumer, computing. Most of their customers were looking for secondary suppliers, and given their small scale, they were seeing a lot of greenfield opportunity and an opportunity to gain content share within their end markets. So that was, part of what drew us to the name. They were also seeing a lot stronger growth within industrial and auto and computing, which have higher margins than the kind of legacy consumer space. So, it was a very high quality name, strong growth, solid secular themes, well managed. The founder is still the CEO of the company. So that was some of the initial thinking when we bought the name originally. And I'll pass it over to Aaron, who covers the name now and can kind of give some perspective on how that thesis has kind of developed to now.
Hey everybody. So for Monolithic, the same themes kind of still continue for the company. They've diversified into other end markets actually as well. So you're starting to see data center, that end market become a bigger part of the growth. And what does work for them, and as Nick mentioned, is the power solutions. They have a much lower power product than some of the competition, so that makes it very useful for their end customers who have to be conscious of that, especially in the auto and data center markets. And something that's kind of that wasn't necessarily a piece of the original thesis, but has come about, is they're beginning to sell more modular or kind of full complete integrated circuits as opposed to discrete products. And so what that does is it provides value to the customer, because it's actually at a lower price than if they were to kind of build all the individual components and put it together themselves. And it actually provides pricing power to Monolithic. So it's both a growth driver on the revenue and the margin front for Monolithic.
So just a couple follow-ups to that.
Yeah.
And I think I want to bring it down to kind of the level of some of our clients maybe too, because I think clearly there's a level of expertise and professionalism that goes in to the analysis that you perform prior to making a selection on this. Maybe in the simple terms you can, how much time do you spend on investigating and performing due diligence and analysis before you actually execute on purchasing a stock holding in the portfolio? What goes into that process? How long does it take generally to pick somebody?
Yeah, so I think it varies. A lot of times, idea generation can come from a lot of different places. Sometimes it comes from the PMs or the product head. Sometimes it comes from the analysts. It's a very collaborative process. And so, we'll typically, spend several weeks putting together a presentation on a particular stock that we're going to look at in a committee meeting. We'll have the committee meeting. There'll generally be questions that follow and follow-on analysis that happens. And again, we're focused on long-term investing. We're not trying to time the market. So, we are patient with these things, and sometimes it can take several quarters before we're fully comfortable with adding a name.
Perfect. And so, and just maybe to kind of piggyback on that idea of the long-term investing, and I apologize, Brian and Aaron, and if you won't understand this, but for our clients, just so we're clear, in the context of smart retirement, this is a red bucket strategy, right? This is one of our long-term approaches. This is not a defensive model. This is not tactical in nature. This is not yellow. This is red money. So it's designed to be a long-term investment that we look for the fundamentals of why we own a company, and then we let that play itself out because we've done a lot of upfront due diligence. Maybe two more follow-up questions to that theme, guys. One is, how many people are involved in that process? It can take several quarters. How many people get involved in that process? And then second, to kind of follow up with Scott's prior question, what does the process look like on the back end of this? When you guys say it's time to move on from this stock, what is the process and triggering events that trigger that?
Well, in terms of the team size, it's the investment policy committees. So each product probably has, I don't know, 5 or 6 people on each product. But Nick, did you want to touch on the sell?
Yeah. So the sell discipline for us, when we put together a report or do our analysis on a name, we generally put it together a thesis built around qualitative and quantitative factors that we'll monitor throughout the holding period. And so there's really two reasons we might sell a name. One is if it moves out of the market cap range that we mentioned before.
It gets too big.
Yeah, so if it gets too big for mid cap or for SMID cap, and then really if our thesis is challenged, or if it breaks, if there's something wrong with the company that isn't meeting the criteria that we set out in the thesis originally, that would typically trigger a sell.
And that's kind of an ironic idea, the notion that a company that we've selected in the portfolio has done too well and become too big to fall within the criteria that makes it a SMID-sized company, and we liquidate it because it's done too well, right?
Yeah, so I'll add to that too. So just to give a little background on Congress, so we started back in 1985, primarily running institutional accounts. So we really started as an organization running pension plans, endowments, foundations, being a money manager on those types of accounts. So when it comes to overall portfolio construction, we have a very strict process around how we construct these portfolios. And just as much as the individual clients who utilize us, these types of institutions rely on us to stay true to to this process. So
that requires a lot of discipline.
100%. Yep. Or else you would not have any assets at this point. So with that being said, for each of these portfolios, we cap each of the names at 40 billion in market cap. And that's really so that within your overall asset allocation, if you are choosing us to be a mid-cap manager or a SMID growth manager, we are going to stay true to that market cap range, and we're not going to have overlap within your large cap space and let winners run from that point on. With that being said, for initial purchase, for example, in the mid cap portfolio, we can look at names between 800 million and 20 billion for initial purchase. So what that means is that essentially, even if you were to choose on the upper range of that, a company at 20 billion in market cap, they could potentially double in market cap while we own them up to 40 billion before we would have to sell. So that tends to be the main reason for turnover within the portfolio, is just like you said, these names do well. This is a space where, again, growth is very, very relevant in this space. And what we see is that within that small and mid cap space, these names continue to do well and hopefully move on to the large cap space.
Brian, do you know the year-to-date return on that SMID portfolio?
So through February, it was up about 8% on the SMID portfolio. Mid was slightly lower than that, but rough numbers right there.
And the idea that you guys are so disciplined, it really makes it's very important to us, because we'll one of the philosophies that we follow here is the idea that we don't want to create a lot of overlap in a client portfolio. And so when we have you guys stay true to the principles of being in that SMID space, and then a winner moves out of the portfolio, that's okay, because we can find that winner in the large cap portfolio without having it owned twice.
Exactly. Yep. And I would say, in addition to that, just going off the theme of the discipline with portfolio construction. So these are high conviction portfolios. What that means is we are taking not necessarily bets, but we're owning 40 names within these benchmarks. So instead of owning an entire benchmark or an index, we're going in and selecting what we believe to be roughly the 40 best names within these two portfolios. With that being said, we cap each of those names and each of those positions at 5% within the portfolio. So you don't have any given handful of names running the entire performance of the portfolio. we keep it properly diversified across all 40 names. So if a name does get up to that 5% mark within the portfolio, it doesn't mean we're going to sell the name, but we will trim it back, reinvest those proceeds so that we continue to keep that portfolio diversified across the 40 names.
Not overly concentrated in one space.
Exactly.
Yeah, and I love what you guys have touched on here, and I hope it's apparent to those on the call that there's a pretty detailed process here, and this isn't unique to Congress, but it is common among the investment selection committees that we use, where there is a lot of rigor on the front end that goes into picking the stock, and then there's ongoing oversight and management. Paul and I will talk about this like minding the store. You're never in a situation as an investor where no one's paying attention to stock XYZ, and we love the focus Congress has on quality, and then we like the ongoing oversight of the positions as well.
And discipline.
That's right. Sorry.
No, I was going to say we might have time for one more if you got it.
Yeah. I have one that I think is super relevant. So I'll occasionally field emails or questions from clients where they'll say, "Hey, I read about this, budding technology, or I read about this advanced medical treatment."
Royal energy.
Yeah. So I'll hear about that, and my response typically to that is we have investment selection committees who are on the prowl for the next cutting edge ideas, and so maybe talk through in terms of new ideas that are out there, be it, AI or new medical treatments or other things where, companies are able to monetize pretty cool ideas. How do you guys kind of stay on the cutting edge of that without maybe going over into the bleeding edge? How do you guys kind of keep an eye out for those kind of next kind of world changing ideas that are out there?
Yeah, absolutely. So before I pass it on, I will say, so we don't take any sort of sector or industry bets within the portfolios. Again, it's all the bottom up fundamental analysis, so that we continue to keep it diversified across each of the sectors and industries. But with that being said, we are constantly on the lookout for new ideas within those 40 names. And so I'll let Nick and Aaron just share a little bit in terms of how they're looking for new ideas in that type of space.
Yeah. So in terms of kind of cutting edge, technologies or buzzwords or things like that, I think the reality is, there are a lot of companies like that in the SMID and mid cap space. And unfortunately, a lot of those are unprofitable. So, we can try and find names that fit those types of themes, but they're fewer and farther between. What I will say though is, just because, we have a bias towards quality and profitability doesn't necessarily mean we can't, effectively find these smaller companies that are disrupting their end markets. And, one example I think, is Paycom, which we originally found in the small cap product in 2015, and it was less than $2 billion at the time. And, they are an HR and human capital management company. They compete against ADP and Paychex and Paylocity. They have less than 5% market share in the space. And really, they were driving a lot of share gain relative to their peers, given, they have this very strong, efficient go-to-market strategy. They had great technology platforms that were driving significant efficiencies for their customers and significant cost savings. And, that's allowed them to gain share and move up to bigger customers. That company is now a $17 billion company, and it's held in our large cap portfolio. So, you can find these profitable companies within small cap that are disrupting their space, and still succeed.
That's a perfect place to end the conversation. Is knowing that, as Scott puts it, we've got a team of professionals minding the store, doing this kind of due diligence, executing with discipline and integrity to the process. And this becomes just one component, one investment selection committee in a broader portfolio that is going to be created for our clients. And so we just really appreciate you guys taking the time with us today to jump on and give a little more color and insight into what Congress is doing when it comes to making these selections within the space of that SMID growth portfolio that many of our clients are utilizing in that red bucket. So, Scott, any parting thoughts?
No, I would just echo Paul, Brian, Nick, and Aaron. Thank you for jumping on today.
Appreciate you guys, and to all of our clients on the call with us today as well. Thanks for spending 30 minutes with us, and being patient with us while we work through our new office technology. We'll start right on time next month. So look forward to seeing everybody again this time next month for next month's AWA Market Minute.